DraftKings delivered its third straight beat and raise quarter and laid out the path to profitability for the company, which is sending shares significantly higher this morning, which this is a great sign for the company. This report is awesome for shares, and I will go into why my thesis for this company is a positive one. I'll give a price prediction at the end of the video as well, so make sure you stay tuned. But with that being said, let's jump right into it. So revenue jumped 88% in Q2, driven primarily by continued healthy customer retention and engagement, efficient acquisition of new customers, product innovation leading to increased parlay mix, and thus higher hold percentage and improved promotional intensity. DraftKings monthly unique paying customers increased year over year to 2 million, which is awesome. This increased year over year to versus 2 million consensus. So all these numbers look pretty solid for the company. But with that being said, let's go into this article here written by Michael Wiggins, which kind of dives into this earnings report more granularly. So revenue growth rates have been revised upward, indicating improved customer retention and debunking bearish concerns. Positive EBITDA in 2024 and sustained profitability from Q4 onwards are expected with a strong balance sheet and no debt. So I thought this was pretty interesting here. His one-line thesis is that DraftKings has what some would refer to as the Peter Lynch hypothesis. This is where investors have one perception of the company, but the underlying company is actually performing substantially better than investors' perception. This means that the company is inflicting higher, but the pervasive narrative many investors still hold is now outdated. So we can see here that as we headed into the earnings report, DraftKings was guiding for 44% revenue growth rates for 2023. Now DraftKings has upward revised their outlook and expects to grow at 58% year over year at the high end. This dramatically changes the conversation facing DraftKings. A company isn't able to guide for its full year outlook to improve by approximately 1,000 basis points halfway through its year unless something remarkably has changed, which it has for the company. So there's massive changes underway for DraftKings. And what has changed is DraftKings has succeeded in improving customer retention. If you recall, the bearish thesis facing DraftKings was that the business wouldn't be able to retain its customers. However, DraftKings was spending huge sums of capital to acquire customers, but these customers would always flock to the newest platform, offering cash incentives for them to sign up and bet on competing platforms. It turns out that the bears weren't right about this, and in actuality, not only are these customers spending a lot on DraftKings, but DraftKings' profitability profile is set to improve dramatically as well. So the customer retention has really been much higher than expectations. And not only did management sound extremely confident that it could get to at least positive EBITDA in 2024, but DraftKings actually was adjusted EBITDA profitable this quarter already. The company outperformed investors' perceptions, delivering impressive results and strong guidance, signaling meaningful EBITDA profitability on the horizon. So amazing quarter for this company. With that being said, though, I'll take a look at some of the financials for DraftKings. So as of right now, the company has a price to book ratio of 13. For those that don't know, it means that the market cap is 13 times the price. The market cap is 13 times the book value of the company. And this is actually cheaper than DraftKings history. So typically over the past 5 years, the 5-year average has been at 20 times. So trading at 13 times actually implies that the stock is trading cheaper than its historical valuation. Also, price to sales is at 5.1, which is significantly below DraftKings' 5-year average of about 20 times. So once again here, we're trading below that 5-year average for DraftKings. So another good sign for the company. And then revenue growth is at 85% 85% for the past 12 months. So revenue has grown 85% over the past 12 months, which is obviously a great sign for the company. And the sector median is at 7.7. So we're growing at a faster clip than the sector. And we're also growing faster than DraftKings 5-year average. So once again, the valuation seems to be cheaper than DraftKings 5-year average. And we're actually growing above the 5-year average, which is awesome, right? And revenue growth for the next 12 months is projected to be at 45%. So all these numbers look very solid. And then let's take a look at the profitability for the company. So we can see here that the gross profit margin is 34%. For those that don't know, gross profit basically just means this is what the company makes once it sells its goods or services. And for here, this is basically just revenue minus cost of goods sold. This 34% number is basically in line with the sector, but what I don't like to see is this gross profit margin is actually below DraftKings 5-year average of 53%. So I don't love that, but there are a lot more positives in the financials, that kind of outweigh that one negative. One all would be that the net income margin is minus 50%. I know that kind of sounds weird to call that a positive, but we're actually below the 5-year average for DraftKings at 83%. So at minus 83%. So decent number there. And then cash per share at $2.36, which is basically about 7 to 6% of the market cap in cash, which definitely implies that the company has the balance sheet to fund its future operations. So with that being said, let's take a more deeper dive into the company's balance sheet, and let's also compare the balance sheet to the peers. So PDYPY, Flutter Entertainment, that is FanDuel's stock here. So I have it right next to it because it's obviously the closer comparison. These other stocks are, gambling stocks, casino stocks, a little different than DraftKings, right? But with that being said, let's take a look at this. So we can see that we have total cash of $1 billion and we have total debt of about $1.3 billion, meaning that the company has $215 million more debt than they do cash. And then Flutter Entertainment has $2.8 billion in cash and then $7.3 billion in debt, meaning that FanDuel has $4.5 billion more debt than cash. So yes, DraftKings has more debt than cash, but when you compare it to FanDuel, the balance sheet is actually much healthier. So that's definitely a good sign to see for the stock. And then let's keep it moving here. Let's take a look at how the valuation compares to the peers here. So for 3 years out, projecting 3 years out here, we can see that the PE is at 42 times, meaning for every dollar of earnings, investors are willing to pay $42. So this compares decently compared to FanDuel, which is trading at about a 35 times PE. And then we have Wind at about a 19, Caesars at 20, BetMGM at 15, and others at lower valuations. So overall, it does seem that DraftKings is trading at a valuation that is higher than most of the peers. So DraftKings is pretty much trading at a valuation that is at a premium relative to the peers. But with that being said, let's take a look at the price to book ratio. So we have a price to book ratio of 13.6, which is well above all the peers, which kind of goes into this general consensus or the general thesis, I should say, that the company is trading at a valuation that is well above its peers. But when we take a look at the growth numbers, we can kind of see why that valuation is so high. So over the past 5 years, the company has grown at a compounded annual growth rate of 64%, which is well above all of the peers. So we have FanDuel at 35%, Caesars at 44%. So DraftKings, yes, it's at a valuation that's above the peers, but it's growing significantly above the peers. So that growth is definitely rationalizing that valuation. And then when we take a look at gross profit margin, we're definitely below the general peer average here. So we can see FanDuel at 58% gross profit, which is above that gross profit margin of 34%. So not the best in terms of profitability, especially when we take a look at gross profit margin. But we can see here also for net income margin, we're at minus 50%. FanDuel's at minus 3%. And basically all the other peers are pretty much flat to positive. So once again, these profitability numbers look pretty poor relative to the peers. And then let's So we went through the balance sheet. Balance sheet looks solid relative to peers. So with that being said, I'll take a look at some of the analyst ratings for the stock. So we saw some price target raises today. So we had Benchmark raise their price target from $32 to 37 in reaction to this bullish, read from earnings. And then we had TD Cowen actually raised their price target $5. Actually, that was prior to earnings. And then we had Need Needham reiterate their buy rating of about $36. So overall, there are 19 bullish ratings on the stock, and then we have 3 bearish ratings on the stock. So this tells me that Wall Street resoundingly is bullish on the stock when you compare all these numbers in aggregate, right? So it is good to see that general consensus on Wall Street is a positive one for DraftKings. So awesome to see that there. We have the highest price target at $37. Obviously, with shares at 31, that's not much room to run. And then the lowest price target is $12. So given that the consensus price target is $27, the average price target is $27, and most analysts are bullish on the stock, this tells me that price targets are likely going to have to rise, right? Because it doesn't make any sense for, let's say, I'll just pick one out. BTIG has a buy rating on the stock, but they have only a $31 price target. That makes no sense, right? It's you can't have a buy rating on a stock and then have your price target be basically exactly where the stock is trading, right? So that will change. We'll see analysts come out with more bullish notes over the coming weeks. That you can pretty much almost guarantee. So with that being said, something you can't guarantee is a price prediction, although I will do my absolute best to give an accurate one. So this is obviously not financial advice, but we can see here that the company has used this 50-day moving average as support on March 22nd, on April 5th, and on July 7th. So let's say shares drop down to this $27 level. I would say that's a pretty good buy zone for the stock, as the 50 DMA has acted as support for the stock consistently over the past couple months. First off, momentum looks extremely bullish for shares, as well as we trade above all daily moving averages, and we also have the 50-day moving average cross above the 200-day moving average on March 1st, which is a great sign for shares. And then really where I think shares could be headed is this $44 resistance level. So this level had acted as support back in July on the 19th and also back in May on the 20th. So past support becomes new resistance. So as we come up to test this level, I do believe we could see some consolidation around $47. Given momentum is so bullish and we're above that major resistance level at $22, which is where I actually called out the stock a couple months ago on this channel. But so this $22 level could also act as support for the stock. It's where shares had topped out in August of last year and in February of this year. So, if we do kind of pull back here, I think the 50 DMA would likely act as support, and we see a move higher for $44. But my official prediction is, even if we get a move down to this 50 DMA, we likely see a move higher to $44 over the coming weeks, barring any massive sell-off throughout the general equity market, which I don't necessarily predict, but obviously anything's possible. And then it's also good to take a look at this screen here. So this shows me which months the stock typically does well in, which month the stock typically does poorly in. So we can see in August, shares typically rise 4.2%. And then in September, shares typically rise 9%. So we're going into this bullish seasonal trend for the stock, which is kind of lining up with bullish technicals, which we obviously love to see. You add it all up, it does seem like the technicals are pointing to about $44 DraftKings for the coming weeks. So that is kind of what I'm seeing for the stock. And also it's worth noting that today we're seeing a massive jump in volume in reaction to shares moving higher off earnings, which does imply that this trend will continue, which I do love to see. So with that being said, I'm pretty bullish on this stock long term. I would want to see some of the profitability numbers kind of fix itself before I put a bunch of long term money in. But I do think this is a pretty decent trade as well, and I do think this is going to be the winner in the sports betting space. I've done a video in the past kind of breaking down their market share relative to peers like FanDuel, and that they have a very significant market share in the sports betting space, which I do love. So with that being said, I am bullish DraftKings. I think it's a good company to keep your eye on, especially if you're looking to allocate capital to the sports betting space. I think this is the one to own. So that is my opinion on DraftKings. I hope you enjoyed the video. I will end it there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone. Happy trading, happy investing.